Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, anyone with the slightest knowledge of investing would know how rewarding can small caps be. They have extreme growth potential, but only those who can stomach volatility should invest in them. If you have any query about small caps and how rewarding can they be, watch today's episode. For today, our in-house experts will tell you all about it. Stay tuned.
Small caps can be very rewarding. The whole story of equity investment is all about, spotting a company or spotting a bunch of small companies with the hope that they will turn big. And as and when they turn big, they turn out to be a multi-bagger. Your money multiplies in a manner which is unexpected. It looks magical. And that is the charm of small cap investing, and investors get attracted to it. There are caveats to this. Just let me give you an example, or the context of this. In 2007, the year before the global financial crisis, small caps went up by 66%. And the year after, 2008, the whole global financial crisis happened. Every investor was running for cover, and small caps went down by 57%. That is something which is stomach churning. It's very difficult to navigate through that. If you invested at the peak and you saw your 100 rupee become 25 rupees, it is very difficult to stay around and stay back and, reconcile with this big fall or this free fall, what I would say. And then the next year, it went up by 100% again. It doubled, nearly doubled, 95, 93%. So I'm referring to all these numbers in terms of the average of the small cap funds. So look at the graph, you will get a perspective that they are rewarding and they are extremely volatile. So to benefit from small caps, you have to really train yourself. And I think it takes a couple of years to get used to it. Just get a context of get a sense of the rewards of investing in small cap funds. If you invested in the best performing fund, 5,000 rupees every month unfailingly for 10 years, your contribution or your investment of 6 lakh rupees would have turned into 21 lakh rupees over the past 10 years. That is a 25% annualized return. 25% annualized return is nearly little over three times more than what you earn from fixed income. If you look at the average fund, not the extraordinary fund, because it's very difficult to spot the best fund which will be over the next 10 years. Assuming you end up being an average small cap fund investor, then your money would have become nearly 15 lakh 22,000 rupees, which is also a very handsome return, nearly 18%, which is twice as much or, little more than twice as much than what you will earn from fixed income. And if you invested in the worst fund, if you are very, very good at spotting the worst fund and you are very unlucky in picking the fund which turned out to be the worst small cap fund, then also it will be about a little over 12 lakh rupees, which is about 14% annualized return. 14% annualized return by any yardstick over a 10-year period is a very handsome return when you compare it with the prevailing interest rates and what you get on a risk-free basis, what you get from a fixed deposit. So small cap has its rewards. Just stick around. The biggest disadvantage of small cap is that they are scary. When they fall, they look like they will never stop falling or they will go down to zero. It's a very regular thing. Whenever you get excited about or when you feel happy about your investment in small cap, it is immediately followed by a big decline. So that is something which you have to really train your mind for, because small cap is not everybody's cup of tea and definitely not for anybody who is getting started. Because the general psychology is that, if your investment goes up by 10%, you feel happy. And your investment goes down by 10%, you are not only unhappy, you are 3 times more unhappy. So the impact of decline, the impact of loss on your mind is far more severe, because investing is a very positive endeavor. You are trying to improve your life, you are trying to have more in future, you are postponing your consumption. So it's a difficult thing. And when you see such a severe decline in value, it's quite unnerving. So the biggest problem is that they are wild. On the upside, we get attracted. On the downside, we get very scared. The second is that many of the cycle can be longer. They can fall and they can remain falling for a while before, and they can be a test of your patience. And then there could be if you're investing in small cap stocks yourself, there could be small cap companies die. They're more vulnerable, they're more fragile, they're small, they are unable to withstand the economic cycles, a downturn in economic cycle. Just to get a sense of the magnitude of decline in small caps. uh, of course, we find that the markets do fall, and when they fall freely. But small cap index, the worst 1 week decline was 20%, or the worst 1 month in the life of the small cap universe over the last 10 years was it went down by 38%. Or you look at the 3 months, going down by 31%. So small caps could be very damaging. They could be a test of your tolerance for the fall. There is a distinct disadvantage of small cap fund, which is if the fund manager succeeds with a couple of his bets, it has a disproportionate effect. It is not unusual for a small cap fund to go up by 50% in 3 months' time. And when that happens, a lot of investors just pour money. And when they pour money, the fund gets big. And when the fund gets big, it gets difficult for the fund manager to follow or do the things that he has been doing to succeed in the same manner. Because when a small cap fund turns big, because a lot more investors are putting money, it gets difficult for it to replicate what it has been doing in the past. So this is one thing which this is the disadvantage of succeeding, what is called in the mutual fund context called winner's curse. A fund wins and then it is cursed with a lot of money pouring into it, and that becomes a serious impediment for it to succeed in future. You can't do anything about the fall, but all you can do is make yourself understand that is how they are. That is the nature of the beast. So make yourself understand that is how they will be. Second is that you can have a long time frame. Only when you are thinking that you are investing for 10 years that you will not be unnerved by today's fall, because you still have time. If you invest your short-term money, you will any kind of reconciliation is not possible, because you need the money and you don't have the time, and small caps will not oblige you. These funds don't know that how important your money is. When they fall, they fall. So two things which you can do. One is diversify and be regular with your investment. Third is that have a long time frame and have a 7 to 10 years time frame when investing in small caps. And I think fourth, the cautionary thing which I would say is about small cap stocks. If you can't diversify well, if you can't choose them carefully, if you run the risk of being a speculator while getting into a small cap, keep off from them. If you're a relatively new investor, don't even consider investing in stocks directly, leave aside small caps. Investing in small caps require great deal of effort. A lot of people think that you just buy and sleep over it and things will work out. No, you need a temperament. You need great effort to spot that company which has the potential. In between, every now and then you will be getting an indication that your hypothesis is wrong. All that you have learned or believed or thought that it will work out is proving to be wrong. And that is when that is actually conviction comes into play. How much can you expand your understanding? So multiple things needed to succeed as a small cap investor or a micro cap investor, which is your ability to understand very deeply about these companies, your belief system. You believe that it will do, and you are able to validate that, to be able to look at them in a dispassionate way. And then you need multiple ideas, because despite best of your effort, many of these companies will die. Many of these companies will disappear. So unless you diversify, unless you have 15 companies, 20 companies, 25 companies, you cannot succeed. Because even if you have 20 companies and 5 of these companies, 5 of the 20 disappear, then only you can be taken care of, because that will happen despite best of your effort. So it's a tough thing. And one should do it after a great deal of understanding, learning, experience, and developing a temperament. Maybe once you become an investor and 10 years of learning, I think you will be better equipped to succeed as a small cap investor. Most individual investors cannot navigate through this complex way of investing, or the way to succeed with small cap stocks. So they will be much better off. The likelihood of succeeding with your small cap is through small cap mutual fund. They provide you very basic benefits, which is you can do your SIP, you can do your 5,000 rupee SIP, you can do your 10,000 rupee SIP. You are able to instantly diversify. And most of the fund managers have succeeded in keeping away from companies which disappear, which die, because that is one of the biggest risks of when investing in small cap stocks, that the company might be good, the business might be okay, but the promoter might be a crooked one, and he will steal the money from the company. So mutual funds have done a better job of keeping off from such companies substantially, not completely, but they have been reasonably successful in doing that. So small cap mutual funds do provide you a very convenient vehicle to participate in this. Choosing a small cap fund, the same yardstick that you will apply for any equity fund, that look at a full cycle performance, because many a times we get attracted to a fund only when it has done very well in the recent past. 2 months return, 3 month return, 1 year return might look very attractive, but how the fund has done in a declining phase of the market, rising phase of the market, and that is what matters, because we are going to invest for the long term. Second is that how experienced is the fund manager, because here the fund manager really matters. In case of large companies, mid-sized companies, or larger mid-sized companies, you don't have the risk of knowing the company in great detail in terms of who is running the company. In this case, the small cap fund manager needs a very perceptive, must be very perceptive of who is running the company. Are they trustworthy enough? Yeah, I think trust is the key, and that requires hard work, because small cap investing, requires meeting companies, understanding where they are, how they are configured, what are the motivation. Do they have it in them? In fact, it is a call on a person who is running a company, that do they have it in them that they really can scale themselves up into a large company. And third is that, when looking at a large cap fund, or looking at a mid cap fund, or looking at large and mid cap, or a flexi cap fund, compared to that, finding small cap ideas is very difficult. And when a small cap fund becomes very big, big meaning bigger than 7,000-8,000 crore, then it gets very difficult for fund managers to keep looking for small cap ideas, because small cap companies have a distinct problem. The distinct problem is that they are not very actively traded. If you want to buy, say, 10 lakh shares of Reliance Industry or HDFC Bank or Infosys, you can just do it. You ask your broker and he'll deliver you, because that is the kind of liquidity in the market. If you want to buy the stock of a small company, if you want to buy 5 lakh shares of that company, the price will go up by 20%, because there isn't enough liquidity there. The promoters normally own more than 50-60% of good small cap companies. So finding stocks having an impact cost, and so spotting a company and having enough liquidity in the market, and your liquidity when you want to buy, liquidity in those stocks when you want to sell, because many a times when you change your mind about a company that you thought this is a great small company, you bought its stock, and you bought its stock 1 million shares, and when you go to sell it, you may not be able to find buyers, or if you somehow desperately sell it, the price will go down by 50%. So there is an impact cost, there is a lack of liquidity. So that is an added risk. Most importantly, when these funds actually become very large, more than 10,000 crore, then even if the fund manager is very lucky to spot a small cap company and buy it in modest quantity, say 2% of the fund is invested in a small cap, and it becomes a blockbuster, it doubles, it will not have a meaningful impact on the fund. So if there's a 10,000 crore company, 2% of that investing in a company, get invested in a company, the fund manager succeeds and it becomes a blockbuster, it has no impact. So a large size of a fund is injurious to a small cap much more than others. So keep these things in mind. But I think besides all this, I would say that your discipline matters most. Sticking through these small cap funds and carrying your SIP through the bad times, through the lean times, is the crucial, is the biggest contributor to your success.
Well, that's all we have for you in today's episode. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.